Hello, everyone. Thank you for making time in your busy schedules to be here with us today. This CE accredited financial planning session is about how you can use SNAP to help your clients optimize their taxes at any age. Today, you will see how we can help younger and older clients alike optimize their financial plans, their financial futures to reduce taxes, improve their financial outcomes, and ultimately help them to achieve their goals. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague Lee Martinson, Snap's Customer Success Manager, who will provide today's demonstration and run the Q&A.
Hi, everyone. Thanks for joining today.
Great. So before we get started, I'd like to do a quick tech check to make sure you can all hear me and see my screen. Can you send me a quick yes or even a smiley face through your Q&A tab? This is exactly how you'll send any questions you have throughout the session. I'll be using the chat tab, and messages sent that way can be public to everyone. So for private messaging directly to us, please use the Q&A tab. Can we see any of those coming in, Lee?
Yes, we have a good group. Thanks, Amanda and Christy and Randy. That's great.
Fantastic. Looks like we're all set. So please make sure you stay until the end to hear about the special offer today. We've got something new, and also how to request your CE credit. Lee and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation. For those of you who aren't already familiar with Snap, Snap is a Canadian financial planning software platform. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. If you want to hear from other advisors who are already using Snap, you can find reviews numerous places online. For example, on Capterra, which is an independent third-party software review site, you will find advisors saying things like none of their clients retire without a SNAP rejection and that the software has become foundational to their firm. As you can see, we are currently sitting at 4.9 out of 5 stars. We have been in market for over 10 years, enthusiastically serving the thousands of financial advisors, planners, and investment managers who partner with Snap to grow their assets under management and increase quality referrals. After this session, if you are curious about specific use cases for targeted planning needs, such as insurance planning or corporate planning, please visit snapprojections.com, and under the Use Cases tab, you will find what you're looking for. We are pleased to now be providing comprehensive French language solutions, which includes the software in French, as well as customer support and product demonstrations with a French speaking team member. So let's get to it. I'll start with introducing you to today's first case study client, Sarah Clark. Sarah is 35 years old, single, and planning to purchase her first home in 5 years. She is using a TFSA as her primary savings vehicle to achieve this very important goal. Today, we will have the opportunity to model various account types and strategies in order to compare options and outcomes. Our goal is to help determine the optimal way for Sarah to achieve her goal. Next, we have our 58-year-old couple, Stacy and Greg Roy. Stacy and Greg are just 2 years away from their planned retirement. They are about to enter a new era of withdrawing against their assets and want to do whatever they can to maximize their after-tax retirement income. We will have the opportunity to review their decumulation plan and compare various options to ensure we help them achieve the optimal outcome for their retirement. One of the ways we will be able to address these types of questions will be to use the scenario comparison module. When a client has a what if question, we can use this chart to show the net difference of potential choices. We can compare up to 5 scenarios on one page or select just 2, which will automatically populate the third column showing the difference between choices. And that's what you're looking at on the screen right now. This is a simple, automatic, and impactful way to demonstrate your value as the advisor. So let's get to the fun part. I'll get Lee to take over now and log into Snap.
Perfect. Thanks, Alex. Just going to share my screen here. Okay, here we go. So Snap is a web-based platform, and this is going to allow you to access your account from any computer without the need for a download. So you just go to snapprojections.com and click the login up at the top. Now, since I've already logged in today, I'm just going to be taken directly into my client list, but you will have the option for your username, password, and even two-factor authentication if you wish. And today, as Alex mentioned, we're going to start with our projections for Sarah, who is saving to purchase her home in 6 years. So she's currently saving into a TFSA for the down payment, and she was unaware of the option that she could use the first home savings account. So this is a great opportunity to educate her and compare these saving strategies. So just before we jump into her actual projections, I do have a slide that I'm just going to review with you to talk about the transactions that are going to happen in the year of the purchase of the home. So she has a target purchase price of $550,000, and she's expecting some additional costs here of $20,000. So total needed would be $570,000. Her plan is to put down $100,000 from her TFSA. She currently has $65,000 saved up, and she'll be saving another $8,000 a year until she buys the house. Also, she's lucky enough that she's expecting a parental gift. So her parents have offered $60,000 at the time of the purchase. So what she'll have remaining to come up with is $410,000. Her mortgage, we could take out for her then, let's say $400,000, and that means that she'll have to come up with an extra $10,000 that year from her cash flow, which is possible because she won't be saving into her TFSA that year. So that's $8,000 and an extra couple thousand from her cash flow. All right, just that hopefully will help out a little bit as we jump into her plan. So for Sarah, I've already created the start of the projections here, just so that we can come through things a little bit faster than entering everything at once. I end up right here on my scenario setup for Sarah, and that's what I've filled in already, starting on the client page where we can see her province and birth date. Next would be general. We're starting the projections in 2026. She's planning to retire at 65, and we'll show the projections until she's 100. We're using the inflation rates that come from the guidelines from FP Canada. So I could click what's this to see more details about those long-term projection assumption guidelines. I've also set up my rates of return for cash, fixed income, and equity, and I can appropriately set my defaults going forward for new scenarios that I create. So next we have the expenses page where we can enter in the details that Sarah has for her planned expenses in retirement. So this is her after-tax retirement spending annually of $60,000. And you can always hover over the question marks to get additional details. This is the additional cost, $20,000 for that home purchase, just happening in the year that she turns 40 when she purchases the house. Next, we have her incomes, and this is where we have her employment income, indexed at 1%. The type is employment income, taxable, RSP eligible, and it's going until the end of the year she turns 64 because she's retiring at 65. Her gift from her parents is an additional income that we can enter for that $60,000. Coming in that future year will be non-taxable, non-RSP eligible, and happening in the year she turns 40. All right, so next we have her assets. Sarah already has a RSP account of $113,000. This is where you would select what type of account it is. She's invested right now with 100% equity at 5% rate of return. And this is her TFSA as well. Currently has $65,000. And this one is invested with 50% fixed income, 50% equity for overall total rate of return of 3.75%. Along the top of this table, you'll notice some additional pages. So we have a TFSA detail section where we've indicated up to date she has $44,000 of room. So this is telling the software that the maximum she could contribute in 2026 would be $44,000. So you can adjust this based on your own specific clients. For RSPs, her contribution room just has been defaulted here to 26,100, or you can update it to whatever is the case for your client. That RSP will convert to a RIF at age 71, which is the default, but you can change the age here if you prefer. And I don't have anything else for her under the other sections, so we can take a look at this house. She's planning to purchase the house for a cost of $550,000 in the future, so that's why the value is currently zero, because she doesn't own it yet. After that point, it will start appreciating at 2.1%. She's going to purchase it in the year she turns 40, and we're going to specify that it's going to be the end of the year. So I can just use this little gear to be more specific about the dates, or if I prefer to use actual dates instead of ages. So this will be the end of the year she's purchasing the house, and capital gain tax is no. So the next page we're going to go to is debts page. Here, Sarah has a mortgage that she's going to start in the year she turns 40, $400,000. Will have an interest rate of 4%. And again, I can adjust this so that it is the end of the year that we'll start paying down that mortgage. We have interest and principal being paid at $2,150 a month. It's not tax deductible, and it is linked to her house. If she were to sell her house before the mortgage is paid off, Snap would automatically pay off the mortgage because I've linked it to the home. Okay, next we have government benefits, where we've indicated for Sarah an 85% of the maximum at age 65. So we're starting the CPP benefit at 65. What Snap Projections will do by default is give you the national average for a Canadian receiving CPP, which is about 59% of the maximum at age 65. So we've increased that for Sarah to indicate we expect her to receive more than that national average. For OAS, we've indicated 100%. That is the default that at 65 she could expect. The next page we'll look at here is the insurance page, where I've set up that she will take on a term policy when she buys the house, covering the mortgage. And this is just an example, but this is how you can put in this example, a term policy for 20 years. And the premium will be $800, and it will go to her estate if there's any death benefit to be paid out. So next we have remaining pages, but in Sarah's case, I don't have anything that I need to enter for corporations or education and so on. So I'm not going to go through those ones for this projection. And what we'll do is jump right out to the planning page. So this is the second section, starting from scenario setup, the planning pages, and then the client report. So next up here is the planning page. All right, so this example is really going to show you how useful the planning page is. And we can see all years of the projections here for Sarah and how everything that we entered into the scenario setup is going to come into play. I know it looks like a lot of numbers when you're first looking at it, but that can be real positive because you can see everything all at once here on this one page. We'll walk through from left to right and top to bottom to let you know what you're looking at here. Starting from the left, we have the age that Sarah will be by the end of the year. So she'll be 35 by the end of 2026. And under the expenses column, this is going to be calculated for me in this section of the projections. What Snap is going to do is add up all of the income that's coming in and then subtract all of the expenses going out. And what is left over is shown for me here under this base expense column. The nominal dollar amount is the indexed amount with inflation. So we have the employment income coming in, $145,000. And those additional things a little bit later on when she does buy this house, the closing costs are listed as well as the gift from parents as additional income. CPP and OAS won't be starting until she's retired, and we'll take a closer look at that year in a minute. But we have her taxable income, her CPP and EI contributions, so these would be deductions from her pay, her total taxes, marginal and effective tax rates, and now we're on to the assets here, so the RSP and TFSA. Sarah is going to be making some savings into her RSP, and to do that, I'm going to enter it right here directly on the planning page. As it's a blue value, I can just click on it and start entering information. So she'll be making $18,000 a year savings contributions. We'll index that at 1% because we've indexed her employment income at 1%, and it will go until she retires. Also for her TFSA, this is where she's saving for her house. So the $8,000 a year until the year she is 39. And I'm not going to index that one. And then in the year where she purchases the house, she's planning to take out, so a negative $100,000 just in that 1 year. And as you noticed, everything that I've entered here has just become yellow in the background. And that's just to indicate that we've entered this value as what we call an override. We overrode the zeros that were there that were calculated automatically. And now in order to get the calculations to update, all we need to do is come up to the top and select Run Scenario. And this Run Scenario button has turned yellow for me just to indicate that there were calculations that needed to be updated. Now it's gone back to green, and that indicates that we're all up to date. So these values are the end of the year values after the contributions and after the rate of return has been applied to these accounts. If I just jump back quickly to the base expense, we have a lower base expense now because she's saving money into those assets. So that's basically an expense, and there's less money left over for her to spend on her lifestyle. So continuing over to the right, we have her house is zero until she purchases it. The mortgage will start in the year she purchases it, and we're only paying $69 that year because we started it on the very last day of the year. But going forward, we'll see the full annual amount. We have her life insurance and the premiums, and then we have information about her net worth, her final estate, and details about the estate taxable income and the tax on the estate as well. So one thing Sarah is going to want to know is, is this doable? Am I able to purchase that home? And am I also able to retire when I'm planning and spend what I'm hoping to spend? So right here on the planning page, we can answer those questions for her. So let's take a look at that first year where she's purchasing the house. We can see that she does have about $77,777 left over at the end of the year, which is pretty similar to the year before. Things look like they're in good shape. She does have to come up with an extra couple $1,000s, like I mentioned before, for her spending that year. But we can see everything right in line. Her additional closing costs, the gift, the savings that she's making to her regular RSP savings, the withdrawal from the TFSA, the new house value, the new mortgage value, and everything looks good. So there's her short-term goal. We've got that set up. So the next question is going to be about her long-term retirement. So if I scroll down, I can see the year that she starts wanting to spend that $60,000 a year of retirement spending. Snap will index that amount for us automatically under the nominal dollar amount. So the calculations are all based on nominal dollar. And what the software is going to do, because we have now a target spending, target base expense, starting at what we call our cash flow management start age, which is where we do enter that target spending. And in the years before, remember, it's just calculating what's left over, and it's assuming that that is spent for us. Now we're putting in a target, and this is going to allow Snap to see what's the money that's coming in, and do we need any additional income? And it starts withdrawing for us from the accounts in order to reach that spending target. So if I continue scrolling down to the bottom, I'll see at the end of the projections that she does still have money left in her RSP and her TFSA. I can also take a look at her estate before tax. So this little menu up at the top will show me the final estate that she is in a positive situation Her final estate after tax would be $2.2 million. And in real dollars, so in today's dollars, that would be like having 570,000. So she is in a good situation here for retirement as well. I can also take a quick peek at recommendations, and this gives me more about her spending in retirement and her goal that she's overfunded. And it would even tell me if I click this calculate button how much more she could spend if she wanted to increase her spending and fully deplete her financial assets by the end of the projections. So in this case, she could spend an extra close to $1,500 a year. So instead of the 60,000, it would be 61,459, and we could apply that to this plan if we wanted to. So this is showing her that she's in great shape for both short-term and long-term objectives. What else could we do for her in this plan? Well, there's a bunch of things that we could look at, but right now, because she was unaware of the FHSA option, I want to show you how we can potentially improve her plan by using an FHSA. So I'm going to come up to the top of the projections and click this copy scenario under our menu. And what this does is gives me an extra copy where I can compare back to my original. So to change the name, I can just click on it, and let's change this up to FHSA savings. So what I need to do now is create an FHSA. So I'm going to go back to the scenario setup and the assets, and down adding a new financial asset. This is the FHSA. There's nothing in it right now. So I'm just tabbing across here. I can choose that type of account, and we'll make the same asset allocation, 50% fixed income and 50% equity. And then along the top, I want to select the FHSA tab so that I can indicate that she has $8,000 of room carry forward, that she's never contributed, and that this is an account linked to her house as well. Okay, so back to the planning page. There's just one last thing that we need to do, which is to make the contributions into the FHSA instead of the TFSA. So I'm going to do that $8,000, copying to age 39, and I'm going to remove this TFSA withdrawal because we're not going to be taking that full amount out, and run the scenario. Oh, I forgot to delete the TFSA contributions. Okay, so that's a quick fix. I just click on the amount I don't want anymore, and I choose clear override. So that's going to take off the savings that I've done previously. It will get rid of the yellow background, and I just update it again. So what we can see here are the $8,000 savings going into the FHSA, and she's reaching that $40,000 limit. It will block us from making more than that amount of contributions. It's automatically withdrawing from that account when she purchases the house, and this is a qualifying withdrawal that goes into the house purchase. The FHSA contributions will be providing a tax deduction for that same amount, and the withdrawals will be tax-free just like the TFSA was tax-free withdrawal. How much money then do we need to take out from the TFSA? Because now we are only getting $43,115 from the FHSA. So the difference between 100,000 and that value would be the 56,885. So this will allow us to take a $100,000 withdrawal down payment, just like in the previous case. So that should be exactly the same, the amount of money that she's bringing in. And we can see over here, this 77,777 is exactly the same as the last plan. But we do have some tax deductions that are happening for the FHSA contributions. So where can we see that? Well, one place is if I come to the taxable income section and I take a look at the menu here. This is going to open up a larger table that comprises all of my taxable income. And where did that come from? So we had employment income, and then we have some deductions. So hovering over this question mark, I can see that the deductions in her case will be coming from RSP contributions, FHSA contributions, as well as the additional portions of the CPP enhanced contributions that can be deducted as well. Now, those are all added together to give me this total deduction. So the next thing I want to point out is a way to dive a little bit deeper. Under our total tax column, this is a new feature where you can click on a value. So in any given year, I've just chosen the first year. And this is going to give you the full T1 and worksheets and federal and provincial schedules and so on. So if we scroll down, we'll see that there are RSP deductions. So here's the RSP deduction, the FHSA deduction, and then further down below is um, the additional uh, deductions for CPP. Where is that? Up here. No, enhanced. Here it is. 1127 is the additional enhanced contributions. So those are where, like, this is exactly all the deductions, all the credits, everything that you would want to look at for the income tax and benefit return, as well as line numbers and section numbers and so on. So you can really dive in and get a good understanding of how the taxes were calculated in any given year of the projections. But Stacy's question is this a better projection than the last one? So the next thing we're going to do is take a look at the compare scenarios feature where I will select compare scenario and we're going to look at the previous case. So two scenarios we're looking at together. I'm only going to compare from age 35 to 40 because that's the time where I made a change here in the projections. And the main difference is going to be that her lifetime expenses are going to be increased. So this means what she's able to spend in those first 5 years, first 6 years of the projections is more. Why is it more? Well, it's because her lifetime personal tax up until that year is less. So the 179,512 in the first plan with TFSA, it's actually less now by 16,821 by getting those tax deductions for her FHSA contributions. So we could tell Stacy that, sorry, we could tell Sarah that this is an improved projection. She's saving herself almost $17,000 and she could use that towards additional spending like it's doing right here or saving more towards her new house. So that is the plan here for Sarah. All right. And Alex, if there's anything you need me to stop about, go over, let me know. Okay. So,
Yes, I will do. Actually, there is one quick question that's probably relevant right now before we move on, if you don't mind, since you
yeah,
offered.
I will.
Just one question. It says, I may have missed this, but why did her expenses drop at age 41 and continue to decline each year under the real column?
Okay. So why I didn't really point it out in particular, but it's because she now has a mortgage payment. So that 25,000 over here, 800 of mortgage payments is reducing what she has left over to spend on her lifestyle. So that's why it is now less.
Perfect. Thank you.
Okay. So let's dive into the next couple. And okay, the next couple is Stacy and Greg, and I'm going to jump into their base scenario. And once again, I'll start with the scenario setup just to quickly review the situation that they're 58 years old, looking to retire when they're 60. We're running the projections until they're 100. We've used the same inflation and rates of return. Jumping into expenses, they're hoping to spend $90,000 a year in retirement with an additional $10,000 a year of travel until they're set like 69 years old. So the first 10 years of their retirement. They're currently working and we have their employment income entered. Now that we have a couple, we have two pages. So there's a page for Stacy and a page for Greg, and they each have their employment income listed on their own individual pages. Same for assets. We're looking at Greg's assets to start with. So it does tell me again in the header. So just make sure you're looking at the right person. We have a joint non-registered asset that is currently $236,000. And then Greg also has TFSA, RSP, and a DCPP. So for the DCPP, I'll jump over to the employer matching tab because I want to show you that we can elect to choose employment income as a linked employment and that the employee and employer are contributing 6% a year. Because that is a DCPP, we have a little bit more information we can enter about that as well. Ontario jurisdiction will convert it to a LIF at age 59 and unlock 50%. And that unlocking will put money into his RSP. And also for the TFSA, we've elected in this case to maximize the TFSA contributions for this scenario. What does that mean? So this is a great feature where we can automatically move money from non-registered assets into the TFSA automatically. So if there is money available, it will transfer it for me, and it will even use spousal resources if necessary. So if they didn't have their own non-registered asset, it could use money from the spouses to transfer over. Looking at Stacy, I have her non-reg, TFSA, and RSP as well. And they own a home currently valued at $765,750, appreciating every year. It is a joint asset, and there's no capital gain tax associated with it. Under the debts, we have a mortgage. They're planning to pay off aggressively over the next few years with $2,500 a month payments. Joint payments will come equally from each spouse. Government benefits. Although they're retiring at 60, they've right now elected to start taking their benefits at 65, and we've entered in the percent of the maximum that would be applicable as well. So for Greg, same thing, starting at 65, and he has a little bit lower expectation for his government benefits. And again, I'll skip over the other pages because we'll just dive right into their planning pages. Once we have a couple, then we notice that there's going to actually be more than one planning page. So we're going to have 3 planning pages. There'll be one that's combined, one for Stacy and one for Greg. And you want to look at their individual planning pages for the specific contributions and withdrawals that are happening and their own taxes and so on. So for Greg, we can see his employment income here. Over the next couple of years, again, we're assuming whatever's left over is going to be spent. We have his taxable income and his taxes. We have these automatic contributions that are happening into his TFSA, and those are coming out of the non-registered asset automatically. So this is automatically happening for me. And if I hover my mouse over it, it will actually tell me that it is a transfer. So here it says the contribution room as well as transferring coming in of $7,000. We do assume over time that that will go up by $500 with inflation. So that is why we have a jump there in the 3rd year. His employee and employer contributions are going into his DCPP. And then when he retires, it's converted to that LIF. And this will show me again what's the minimum and maximum withdrawals that are happening from this account. Right now, it's sort of in between the minimum and the maximum, just based on their spending needs. And we could force minimums or maximums by using an override. So, for example, a trick would be to enter a higher amount to my RIF withdrawal, copy that down, and Snap is smart. It's going to prevent you from taking too much money out. So when I run this scenario, it will automatically put the highest it could be allowed. If 25,000 is too much, what would be allowed? And it automatically puts that in for me. Just to keep things clean here, I'm going to clear that override for now, but we'll talk a little bit more about maximums in a minute. So you may be also wondering a little bit about how does it know where to take money from when we start withdrawing? And we have what we call the cash flow management order. So the order column for this scenario, which by default is going to be taking money out under this order column. We'll see withdrawals coming from non-registered first, TFSAs, and then registered. So this is the default. It's a tax deferral strategy that's been shown through research to help minimize the chance that the client will outlive their money or and in the majority of cases that you're going to find that this is a great default to start with, which is why we have it set up that way. So we're going to be withdrawing from non-registered first, then TFSA, and then registered accounts. So we're reducing the future taxes payable on investment returns and deferring the taxes payable on registered withdrawals. But what we're going to do in the next scenario is take a look at adjusting that as well. So we can always look at optimizations, but by default, that is how Snap will work. I'm going to just go into the combined page because they want to know now, this is a great summary page. Are we going to be okay? Do we have enough money? Is our retirement on track? So we can take a look at this combined page where the main thing that you're going to be editing on the combined page would be expenses. And other than that, you're going to be looking at what's happening in any given year of the projections. So we have their financial assets totaled up, all the non-registered, TFSA, and so on. So we have in all types. If I scroll down to the bottom, I can see that there's $559,000 left in all types. That's one way to tell that they have a positive state there at the end of the projections. And just to show you a quick switch view, if I click on this little arrow to the right, this is going to show me that they have all individual assets as well. So if I kind of scroll up to the top, there's their joint non-registered, there's Stacy's TFSA, and again, hovering my mouse over will just make sure that I can tell whose account that is. Stacy's making some RSP contributions in the first few years. She also has the TFSA automatic contributions. And and then we can take a look too at the recommendations. So that again is where it tells me their goal, that they're currently overfunded, that they could spend a little bit more, I could calculate. And the other things that you could take a look at too would be maybe they could retire earlier, or maybe they could use up some of their savings now, and so on. So there are other calculations that you can look into, as well as the sustainable spending. Now that we have a couple here, it takes a little bit longer to calculate, but it still is going to give us the answer, which is they could spend 3,386 more per year in their projections. And what I want to highlight is some of our new details here. If I come over to the very right, under balances, there's the arrow that's pointing to the right. I'm going to click on that because this is going to give me some more columns. And I'm going to scroll all the way over here. So we have an expanded view now. And each of these sections have these little tables at the top. If I click on, it's going to give me more information. So the first one is like I looked at in the last scenario with Stacy, that or estate after tax in the final year of the projections would be $2.375 million, and the estate after tax in real dollars, today's dollars as well. There is a tax on estate number. How did this get calculated? Like how much was their estate taxable income? Well, now we have a way to dive into that information, and that is the next column, which is state taxable income. So if I click on that table, this opens up for me. So every single year we see other income. So this is going to be coming from their registered withdrawals, non-qualifying FHSA withdrawals, other taxable income. So in this example case, we really don't have a lot going on. It's just mainly registered money that would be responsible for their final taxable income for their estate. But we do have some capital gains due to the non-registered assets as well. So where it could actually come into play a little bit more is if you had more capital gains, maybe from deemed dispositions from secondary properties, or if there's corporate distributions and so on. The deductions here, so this has to do with typically OAS clawback. So if they received OAS in their lifetime, like that year, then it would be deducted from their estate taxable income. And on their estate tax on estate, we also would have the recovery tax. So they would be getting clawed back from any OAS that they received that year. And one thing to point out is that we're assuming that they both pass away in the same year. So for all of these calculations, it's assumed that they both died on December 31st of whatever year we're looking at. If you were to create a projection that had one spouse pass away before the other, there would be a rollover of assets and everything would work through the projections that way. But for the estate information, we are assuming the death of both at the same time. But we can also go into their individual projections and take a look at the details for their income tax in any given year. And the one thing I wanted to point out for Stacy, let's say, if I look at her total taxes in this given year, $610, there's this pension income splitting column that's just kind of hidden over here on the left, that she's receiving some pension income from Greg, and that is going to be shown here on my T1. So there's that split pension amount, and she would also be receiving the pension credit. So you can dive into all of those details. So that pension amount, she'll get $800 for that. And one thing that we've recently changed in SNAP is to make things more realistic, potentially, when there are RSP withdrawals. So this account for Stacy is still considered to be an RSP until 71, where she converts it to a RIF, and then at 72 is where the minimum RIF income has to start. But before then, these withdrawals from the RSP are now going to be considered to be pension income in the software. So it's like we're converting a portion of the RSP to a RIF and withdrawing everything from that RIF that we just made. So if I look at that year's details, that 43,195, which is her RSP withdrawal, is considered to be a pension and is then eligible for pension income splitting and the pension income amount. So it should be beneficial in your projections. And you don't have to then manually go in and convert to a RIF. Snap will automatically consider it to be RIF income for you. So the question that they're going to have is, well, maybe not that they're going to have, but what you want to show them is maybe how you could improve the projections for them. So again, we'll make a copy of the scenario and keep this base case the way it is. And we're going to take a look now at optimizing the withdrawal strategy. So in this version, we'll use a new feature that we have. It's called taxable income targeting. And to do that, I'm going to just look at Stacy's projections here to start with. So diving in to Stacy, we have the tax rates area. And in the early part of her retirement, she has very low marginal tax rate because we're taking, again, mostly from non-registered, then from TFSA. There are some small withdrawals happening from the RSP. And the reason that SNAP does that is because she's at such a low taxable income that it can take money out tax-free for her automatically from the RSPs. And it will do that. So it's already trying to optimize your projections that way. But potentially, let's take a look here at the chart for Stacy. So there's quite a few charts and they're all interactive, but I'm not going to go into too many details here unless we have some time later. But this cash inflow chart will show for you, if I hover my mouse over the taxes, I'm just looking at Stacy now, but we can see a drop off in taxes after she stops working. And then the first years of retirement are very low taxes. And then we are paying more taxes later on. So another strategy could be to maybe pay more taxes up front and then they'll have less taxes later. We have this very low marginal tax rate. Then we have the 19.05% and then 23.15. Let's see if we can keep her at the 19.05% throughout the projections. And to do that, I'm going to click on the gear under taxable income, enable taxable income targeting. We'll start that when she retires. And what this will do is give me a new column, which is called the target column for the taxable income. And I'll be able to see that by default, this target column is exactly the same as my actual column. So when I first turn it on, they're exactly the same. But now I can take the time and I can enter in a target. So what would my target taxable income be? Well, one thing that we can do is we can go to the Ontario, because this is where they live, is Ontario. So we can do the combined federal and provincial income tax rates. So at 19.05%, the top of that tax bracket would be this 53,891. So I can use that value and come back into my planning page here. And that 53,891. So let's just do 53,800. And I will tell the software that that is in real dollars. So that is the amount for this year, but I'm applying this in 2028. So I want to say that it's in real dollars. So it's in today's dollars, this 53,800. And I want to try to keep the taxable income like under the top of that tax bracket. So that's why I'm picking that value. I'm going to copy this down to age 100 and I'll also copy to Greg so that they'll have the same taxable income target. Then run the scenario and see, can the software keep me at that taxable income target? How is it going to do that? Well, if it needs to get higher taxable income than it had before, we'll see that it's making more withdrawals now from the RSP. So until she's 65, those will still be considered RSP withdrawals. But as soon as she turns 65, they would be considered RIF income. The marginal tax rate is staying now at 19.05% all the way down the plan. If I take a look at the charts, we'll be able to see that if I click highlighting that tax line, so now instead of dropping to zero in those first few years, we have a more stable tax paid, and it does drop off very low at the end of the projections. But the question is this better or worse? So we can see what it's doing. Now we just need to compare. So if I come back to the combined page, one thing again that we can do is just take a look at our recommendations. Do they still have enough money at the end of the plan? The goal progress is actually the same, 106%. We had previously calculated, I think it was around $93,000 a year that they could spend instead of the 90,000 in the original scenario. Let's take a look at what they could spend now. And still 93,429, which is very close, I think, to what we had in the last plan. So just by looking at that, it doesn't seem to be too much different. Again, we can look at their final estate and see what their final estate is in the very final year of the projections. But another way to look to compare is what we did before, which I come up to the top and I choose compare scenario. So now I'm going to compare the original with my taxable income targeting scenario. And again, when we have two plans that we're comparing, we get this difference column, which is really helpful because we can see that their spending is the same, their lifetime expenses is the same, which is what we want. We don't want to compare two scenarios where they're spending different amounts of money. This is exactly the same spending. Their lifetime personal tax is actually less in the version where we're using the taxable income targeting. So they're paying more taxes up front, but then overall it ends up being less taxes. Their government benefits are the same. Financial assets are actually less at age 100. So up at the top, I'm comparing here to age 100 in this case. Their real assets are the same. Their total assets then are slightly less again. Their final estate is less before tax. And also tax on estate is zero here in this version. And then estate after tax is higher. So by $37,000, it's better at age 100 to have used this taxable income targeting feature, which we had set their marginal tax rate at 19.05%. But this is just in one given year. So this is just at age 100. I could change the end date here and look at a different age. But we have something called trends, which is great because I can compare year over year. Is this better in all years, for example? Here's my base expenses, which are exactly the same, which is what I want to see. Personal taxes. So hovering over this, with the taxable income targeting, it's higher taxes earlier on, lower later. And then with the base scenario, it was lower and then higher. But in the end, what we want to compare is their final estate. So their estate after tax. This base scenario with the taxable income targeting for every year of the projections ends up being a better situation for them. And if they were to pass away earlier in the projections, say at age 84, then it's about a $400,000 difference. Their estate would be higher after taxes if they had forced more money out of their registered accounts earlier on. And that's where you can show the benefit of different projections using this comparison feature, which you could then also print out. You could save it as a PDF. But once you decide on the recommended plan that you want to show them and sort of the benefit of working with you, then you can go to the client report and you can elect to choose many different pages in your report under the report builder. We have many pages to choose from. I have a template that I've used from our help site, which actually suggests some example templates to use. This one has what we call a snapshot summary at the very beginning to give sort of an executive summary. And it pulls in information from my projections automatically, which are all the values that are in the boxes here. So just as a very quick preview, we have, I'll take off my highlighter here. We have our cover page, a note to the reader. This is my executive summary showing small little charts and information about what we want sort of to highlight to these clients. And then that can be all backed up in the various larger tables and charts later on. And yeah, so that was the main information that I want to share about those different projections. But I just want to remind you that we're currently building tools that will help to streamline this optimization process to help you save time and create even better outcomes for your clients. And the updates that I showed today, so those included our taxable income targeting feature, the automatic TFSA top-ups from non-registered assets, the RSP withdrawal that's now classified between age 65 and 71 as a RIF income. And so those are all the highlights. And then when you do sign up for your free trial, you'll have immediate access to our help site, which is available up here at the top under our help center. And our customer success team, the phone numbers are right here at the top. But I'll pass it over to Alex to walk us through the next steps and open it up for questions.
Fantastically. Thank you so much. Yes, so we have covered a lot this hour, but we are here to address your questions in just a moment. So, for those of you here today who are already using Snap, thank you so much for making time to be here with us today and for being a valued member of the Snap community. A reminder that you can be earning free months of Snap when you send referrals our way. This program is win-win. The referred advisor gets 50% off their first month of SNAP, and the referring advisor, that's you, gets an entire free month of service when the advisor you sent becomes a paying user. If you are on annual billing, you will receive a $100 credit against your next renewal. There is no limit on how many times you can do this. 6 annual referrals would be getting SNAP free for half of the year. We have created a referrals page that you can access from within your SNAP account that makes it easy to earn free months. For those of you here today who cannot benefit from the referral program, we've got a special offer to help you get started with SNAP. Today only, advisors who sign up for a free trial will get the regular timeline doubled for a full 30-day free trial. This will ensure you have plenty of time to work with as many client files as possible during this busy tax season. But there's more. As part of your extended free trial, you will get access to free tokens to use our brand new time-saving data assist feature. I don't believe that any other financial planning software can do this. And this feature is brand new, so we are really, really excited about it. Rather than entering data manually or relying on integrations that don't always work, you can now upload documents into the software to auto create the first draft of your plan. It's simple. Start with uploading your files. Ideally, you will use something like a completed financial planning questionnaire, and that's something that we provide. You could use an export from your CRM or try client provided statements. For step 2, you'll have the option to include additional instructions or information that isn't already in your uploads. For example, if you'd like to specify that John's retirement age is 62, or make a note to group financial assets by account type, you can add that in. Your last step will be to review the generated scenario notes. And you're looking at an example of those on the screen right now. And this is a critical transparency component missing from many AI tools. We're telling you exactly what was done, what's been included, and also highlighting information that wasn't clear. The AI import assistant enters the data throughout the scenario setup pages, just like you would have done yourself. So once you've done this, you can flip through like you always would, reviewing for accuracy instead of creating from scratch. Your free trial includes 10 free credits, which will renew monthly if you decide to stay with us. For heavy users of the tool or advisors switching software, let's say you want to move 100 client plans from Razor to Snap, you have the option to purchase top-up credits to facilitate this. So today only, you can start a free trial. Normally it's 14 days, but today we're going to give you double that for a full 30-day trial. During the free trial, you will have tokens to use our brand new productivity hack to use the AI Data Assist import feature to create your first draft plans from client data you upload into the software. On our pricing page, you'll see there are two plans for you to choose from as an independent advisor. Advisor Business is the plan you want for the corporate module. You can upgrade and downgrade anytime, so don't worry too much about which one you select today. If anyone would like to see the corporate module, let me know and we'll try to cover that in the Q&A. We also have some really great webinar tutorials on the corporate module we can send out to you. So I have dropped the link in the chat now, which is what you can use to create your Snap Projections account, get instant access to the software, and ensure you get to take advantage of double the regular free trial. Please click that link now so you have it open up on your device before the session closes out. I am going to send you an email shortly. There's going to be a countdown timer clock. You can click that clock up until midnight Eastern time today to get access to this special offer. So we've got a few minutes left. I want to be respectful of everyone's time. So we will just very quickly try to run through the questions that have already come in. So the first question I have, Lee, is
Mm.
can you show us how we would add in repair and maintenance as well as insurance costs, home insurance costs into the projections when buying the first home? So bringing us back to the first case where we're looking at purchasing Sarah's first home.
Okay, so if you wanted to add some additional expenses, I mean, you could assume it by default, it's assuming that that would come out of her base expenses here. But if you wanted to actually have an additional expense, it's going to be under our expenses page. It's just like we added these closing costs. We could add, maintenance. That was one thing. Whatever, however much you wanted to say, I don't know, $5,000 a year. We could say that we want to index that with inflation, and it's going to be happening from when she's 41 until the end of the plan. Leave it blank. It happens every year. Highlighting it means we'll see the actual word maintenance in the chart for the additional like cash outflow chart. So then back on the planning page, we'll have that column for her. We'll have a maintenance and it will be here. And it is even editable on this page if you wanted to make edits there as well. So, and if it was additional like house insurance or something, you could add as many, you could add up to, I think, 20 additional expenses. We've purposely, I guess, not indicated that you have to budget every single item because that just takes time, obviously, and assume that all of those things would come out of the base expense. But you can itemize expenses if you wish. That's what it's there for.
Fantastic. Thank you. And that actually covers the second question as well, which was can expenses be specified in working years or is it just the residual, after everything else that we're looking at? So just as Lee built in the maintenance expense, we can build in any type of expense. You can have it at any interval that you need. Complete flexibility there to really get as, detailed as your client requires with their expenses, whether it's cash flow or goals based.
And you could, just before jumping, we could also change the start age to the beginning of the plan to say, I want my expenses to start then, and then automatic contributions or withdrawals would happen from your assets. So if my base expense is $60,000, there's extra money, it's automatically putting more into my TFSAs for me. So it's another option.
Perfect. Okay, next question. What do the client onboarding data collection forms / process look like?
Okay, so we can jump into our help center. This would be the quickest way. And I can just type in questionnaire. One place that's great to go is start here. That will actually be in here, but our financial planning questionnaire is available as a Word document. And it will just run through the scenario setup information that we already looked at and allow your clients to enter in information right there. And then you can scan and upload it, or they could fill it in digitally, and then you can upload it as a doc file as well. So this is where you'd find that.
Perfect. And the other element of your onboarding would be that when you do sign up for Snap Projections, you're going to get a welcome email. And in that welcome email is going to be a calendar link to book your one-on-one training session. So that will be held over Zoom. And typically, that's all advisors need to get up and running with Snap. You get that quick one-on-one time with somebody from Lee's team. And then you've got the expansive online digital library that you're looking at right now. And then let's just try to squeeze one last question in quickly. Um, what if the plan is to purchase an annuity with a defined contribution plan? Is there a way to enter that?
So yeah, you can, it might be easier to go over that like on a separate offline, but yeah, definitely you can withdraw um, from an account that you're purchasing the annuity from, and you'd add an additional expense in that year. Um, and then you would have the annuity either as income coming forward, or you could add the annuity as a defined benefit pension plan. Like, so there's many options. I think just to show there's a lot of flexibility here, depending on how exactly you prefer to show something.
Perfect. Okay, great. Well, everyone, we are out of time, and I'm sure many of you have meetings to hop on to. So we will end it there. If any of your questions have not been answered, I will follow up with you. And thank you so much for being here today. And watch for the follow-up emails to make sure you can take advantage of the special offer. And thanks again for being here. Bye for now.